Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is David H. Smith, who is a senior analyst for the Morgan Report. He just got back from the Silver Summit, too. So thanks for joining us here today, David.
Hello, Jason. It's good to be here.
Great, David. And we were talking earlier before about some of the supply and demand side stuff about silver. You just got back from the Silver Summit. Have you noticed that anything has changed in the demand or the supply side for silver in the last 12 months?
Well, I think there's been one significant change, and Doug Casey and a couple of others have started commenting on this, and I think it is an important systemic change, and that being that a lot of new money is going into physical gold and silver, and especially silver, rather than, say, going into paper derivatives like ETFs or even some of the mining stocks. More and more people are wanting to get the physical, and I think that's going to provide an interesting change in that matrix, in that supply-demand matrix, and this is something that I think is going to be taking place for quite some time now.
Yeah, and a lot of the interviews and the commentary on YouTube, and it's all talking about physical, and they're calling the mining shares and the actual companies that produce the bullion paper, which I don't know, we could talk about that maybe a little bit. I think that's kind of ridiculous because the companies are doing a lot of the hard work. Mining's a very difficult business, and they're pulling the bullion out of the ground. I think it's a chicken versus the egg argument that you need the miners to do the hard work, pull the bullion out, or otherwise there's not really going to be any more bullion for sale, right? The supply, there wouldn't be any left to buy.
Right, and I think this is a bad news, good news thing for the mining sector itself. On the one hand, it's bad news because not so much money is going into the stocks, but on the other hand, it means that the quality producers and exploration companies are going to be the ones that you want to look at seriously, and you want to not take the second and third run types, but to get the very best, what I call best of breed in your portfolio. You want to constantly be winnowing them down so that you have the strongest performers and the ones likely to succeed rather than just scattershot and having a bunch of who knows what the quality is going to be types.
I completely agree, and I've actually been doing that myself, and we discussed that before we started recording. I think it's going to be really tough in these markets for a lot of these exploration companies, even though gold and silver have started going up a little bit before this last correction. I think it's going to be very tough for them to raise capital to even for their drilling programs, let alone to raise hundreds of millions of dollars to build a mine.
This is really true, and I know a couple of exploration companies that have very good projects, early stage, but certainly have a lot of potential. But they need quite a bit of infusion of cash to keep that thing going, to keep the drills going, to come up with another plan and this type of a thing. And a couple of them didn't have a drill season this year because they couldn't raise any money. And so that's really kind of sad, but that's the reality. And my great fear is that the winnowing process for these companies is not fully over yet. And even as we see relative strength of the mining shares in relation to the metals, which has been under for a couple of years to the extent of 2 standard deviations away from the norm, that is going to come back, I think, to closer normal. But it isn't going to rise. The tide is not going to raise all boats. I think as investors, we need to be very, very selective about what we hold on to. And if there's some question about whether or not they can keep raising money, the particular one we have, then we maybe need to really reassess that. Because, in the old days, you could keep an exploration company going with $20,000 or $30,000 a year. You could keep the lights on in the office. But nowadays, you have to file quarterly reports and a bunch of other stuff. And you've got to have $150,000 to $200,000 a year just to keep your name on the nameplate there and keep listed,
Yeah, and then that's not even counting the drill program, like you said. And what these drill programs is a couple $1 million just to run a few drills. So you're looking at a $5 or $10 million drill program on a lot of these guys just for each year.
No doubt, and you end up with massive dilution when you get several hundred million shares outstanding, and you're still an exploration company and you haven't got a legally compliant report on what you've got. I mean, it's sad and. And then the worst thing that can happen is that you as an investor can be right on a particular company, but then it gets bought out for a fraction of what's really worth, and you can lose money even though you had the right company simply because the price is sunk so low.
Exactly, and to add an example to that, like we had a recent acquisition in the last 6 or 7 months of Extori Gold, and Yamana Gold bought out Extori. And it wasn't that good a premium. It wasn't beneficial for Extori Gold shareholders because it was a $14 or $15 stock at one point about 12 to 18 months ago, and then the stock crashed to 1 or 2. And these guys felt like bag holders, and Yamana just came in and swooped up the company, and they got the assets, which is a pretty quality deposit long-term with high-grade gold and silver, and the Yamana shareholders got the assets basically for pennies on the dollar.
Well, you know, I visited that project a few years ago in Argentina, and I concur exactly with your analysis. It was so sad to see them, you know, not realize the benefits of their wise selection earlier on. But that's what happens in these circumstances. And I think Yamana made an interesting decision to buy that property. First, as you said, they got it for a darn good price. And secondly, they have the deep pockets and the understanding and the willingness to kind of lay low until the political situation improves in Argentina, which could take several years. And when it does, they're going to be well positioned because that area has some of the most highly prospective properties in the world, in my view. But you need to lower the country risk by a couple of orders before you know, anybody can seriously commit money in there and think that they might actually get it back someday.
Exactly. And if you just own like 1 or 2 companies in your portfolio, it's very, very risky to have that type of exposure to Argentina. So it's much smarter to buy like shares of Yamana, because Yamana can have a diversified asset base. They own mines in multiple countries, so they can take the risk of owning one good deposit in Argentina and then put it into production in a couple of years because they already have cash flow from multiple places.
That certainly mitigates the risk somewhat, and I'll tell you, I do hold a particular company, an exploration company with what I believe is an excellent project in Argentina, and I'm willing to see that thing drop 2/3 from where it is now to add the rest of the position. So I have a position that, should it run away, which is unlikely, I'll still be on board, but I also have other funds that I'm willing to commit at much lower prices, but I am definitely not going to do any additions until I see substantial weakness, which could certainly occur.
Good. And let's talk more about the Silver Summit since you just got back from there. What was your opinion of sentiment there? Is sentiment really, really negative in the short term for gold and silver, or do you think it's improving?
I think it's improving, and I'll have to say, you know, I go to conferences all over the place, and I attend the ones in Vancouver every year, and I've been to most of the Silver Summits. This was the 10th anniversary, and they minted a coin, and as you may know, Cambridge House purchased the Silver Summit last year, and the people that were in place that got it started are still, you know, making the big decisions, which is great. But you know, there's a different breed of animal that goes to the Silver Summit than a lot of the other conferences. It's a smaller summit, 600-700 people, and the people that I meet there are very serious about their investing, and they're very serious about learning. So they're there to not waste time, and so they're kind of not really what you say is a cross section of the investing public. But they were very positive, and they were very interested in adding to their positions and adjusting them. So I think that is always a tremendous place. I learn a lot every year, and you know, one of the things I do is each year I try to come away with at least one company that I need to reassess my understanding of. And then as I do the research at home, I usually modify what I'm doing with it, maybe add more positions or maybe add a new position. And this year was no different. And it seems that I've been kind of fortunate maybe, but each year that I've done that with the choices, it's helped me financially in the following year. And I think this will be the same this year.
Yeah, I have a lot of newsletter writer friends who went, and of course, David Morgan was there. He was the keynote speaker, right? Or was there other keynote speakers too?
That was correct. Eric Sprott was there, and Greg McCoach, and a number of, you know, John Pizer, and it was very well attended, and people, like I say, were very attentive, and it's just, I really think it's one you don't want to miss, and I hope anybody that maybe has a chance to go next year will do it, because I think it's really beneficial for them. But you know, going forward, I can remember when we were wondering if silver would get above $5 an ounce, and now we're wondering when it will get above $35 an ounce. So this thing has a long ways to run, but silver is so volatile, and I think people are going to have to just become accustomed to these big spikes up and down. It's part of the price you have to pay for being on the silver bull. It's frustrating, but it is not impossible to do. You just have to get control of your emotions and control the fear and the greed that we all have to deal with in these markets.
That is well said, David. And part of the bull analogy that you used is the bull tries when you're riding it to shake you off of it. So that's why we have these, as volatile as gold is, silver is even more volatile. The Rick Roll analogy is that silver is gold on steroids. So that's why people should not go completely all in on their positions at once, and they should keep some cash on the sidelines. So when there's big corrections, like in the last couple of weeks when silver was at over 34 and almost ready to break through 35, and now it's back down below 32, these are good days to be adding to positions.
That is correct. And, I think no matter how certain you are of your analysis about a specific company or about the overall situation or where you think the sector is going, it is very helpful psychologically and financially to keep a cash reserve. A good general almost never commits all of his forces. He has some in reserve so that he can plug holes in the line or exploit a breakout. And sometimes he'll commit them all, but he has to be really, really certain he's doing the right thing because he has nothing left if he's wrong. And I think this analogy is a good one for us as investors because we're really out there on a financial battlefield. And just knowing you have a reserve that you could take advantage of something of what Doug Casey calls stupid cheap prices if it occurs, it makes you feel better. And I learned that lesson during the meltdown in 2008. Early in that year, and no one knew, that's honest, that it was going to be that bad. I didn't know it was going to be that bad, nor did anybody else. But I started with about a 35% cash cushion. And on the way down, I bought quality companies, and I bought all the way down. And before it hit bottom, I ran out of money, And so now that I understand that there can be prices that go so low you can't imagine it, I keep a cash reserve. I really learned that, and it helped me a lot. And I came back from that. I had quality companies, and I sold some of my losers near the bottom and bought good ones that went way back up, so I came back out. But it was a lesson that was very powerful to learn, and I hope other people will consider that too. No matter how sure you are of a particular situation, don't go all in, because once you get in, your flexibility is not only reduced, but sometimes totally hobbled.
That's another well-said point. And let's talk more about the demand side for silver. You mentioned earlier in the interview that the Silver Summit stated that there's just more physical demand from investors. But do you think because of this slowdown, because of the stagflation that we have basically now going on globally with the currency wars, that the industrial demand for silver is going to be declining over the next few years that was not anticipated?
I think there's some concern about that. And, of course, because silver has two faces, as an industrial face and an investment face, it's difficult to really pin these things down. I think the great danger is to get caught in one of these little side currents and think that that's something big that's changing. For example, if industrial demand goes down a little bit, or if investment demand is off that month. I think the key is to keep an eye on the big picture. And if a person isn't margined, which they never should be in these markets, and if they're not over leveraged, and if they have a cash reserve and they have a quality portfolio, they should just kind of keep an eye on the big picture. And if you really think that silver could exceed $100 an ounce, which I believe it can, in the next few years, maybe well above that, why are you worried about a $2 or $3 decline unless you're margined or unless you're in too deep so that you can't pay the mortgage? And that's the key. That's the key, I think, is because if we're going to see the types of price gains that we think is possible, and certainly getting into the public mania phase where David Morgan has stated many, many times that fully 80% of the potential profit for us in the entire bull market can occur in that last 10% of time, which may be a 6-month period. That's what kind of happened in 1980. If we believe that can and will happen, then we need to be careful so that we can stay on board. And a fairly modest investment in these markets could yield life-changing wealth. So we don't have to, get that second mortgage on the house to buy more physical. And I've talked to people who've done that throughout this cycle and been knocked out and are completely out and not back in again. They just went too deep, too fast.
Yeah, and I think discipline is very important, and not using leverage, like you said. We've had consulting clients, and we've sat down with them, and we've told them about gold and silver, and we've told them that they cannot go all in at once. They need to, on dips, on corrections, they need to add more, and they nod their head and they smile and they say, that sounds really easy to make money. And you know what? It's a lot easier said than done. It requires a tremendous amount of discipline. You have to master your emotions. You cannot give in to fear. And the majority of people, unfortunately, are not capable of doing that. A lot of human beings are just not capable of being disciplined like that with their money.
Well, as Clint Eastwood said in the old movie Dirty Harry, a man's got to know his limitations, and we all have them. And David Morgan has said this at talks. He said, you know, the market will find every weakness you have and exploit it. You can't hide it. It will just root it out. And so my feeling is you got to dial down the emotions, and you have to preserve what I call psychological capital, because if you're destroyed emotionally, I don't care if you have millions of dollars of investable money in your account, you're finished. You've got to keep that psychological capital and hang on to it just like you do your money. And nobody in this market is too big to be blown away. I was talking to a metals dealer a few months ago who told me of one of their customers who got a margin call and had to sell $1 million worth of physical gold and silver to meet that margin, and he sold them at fairly depressed prices compared to what, you know, might have been. And if he'd have stayed off the margin, he'd have been okay. So there's nobody that's too big to fail in this business. It might be for the banks because they get bailed out by, helicopter Ben, but for ordinary people with real dollars in their account, nobody is bigger than the market.
Very good. And let's talk about your macroeconomic views here, because the Fed has already announced QE3 to infinity. You've had these other global central banks. You had China announce an infrastructure program. You had Japan devalue. You had the UK devalue. And you had the ECB announce that they're going to start monetizing bonds, at least in a light form. So do you think this is going to put a permanent price floor at a certain price underneath silver, so we'll never see $20 an ounce silver again?
I don't know if you can talk about price floors, although I feel probably what you're saying is probably accurate. But the thing that what people think is a floor, you know, if it gets broken even temporarily, then they completely panic. So rather than thinking about it like that, I'd like to suggest, and Frank Holmes talked about this in January at the conference, where he said the globe is reflating at about a 25% rate of new money. I mean, almost everybody's doing it. You know, we're some of the worst offenders. But I think that higher prices and higher inflation are baked into the cake. But the question is, how long does it take for this money to kind of filter through the system and the velocity to pick up, and that money sloshes into all sorts of investments that the Fed can't control? And a big question is, when does the public start really losing confidence? When do they really get it? And you and I can't tell when that's going to be. We're pretty sure it's going to happen, but if we figure it'll happen at a certain time when it doesn't, and we're kind of out there too far, then, you know, we could become roadkill. So because we can't predict it, but we're pretty sure it's going to happen, we keep our eye, as you said, on the macro picture and make sure, because we're just little fish out there, that we don't get eaten by a big shark. You know, we kind of stay undercover, and we're kind of careful about how we go about our lives so that we don't become a victim.
Very good. And to add to your point there about the global inflation, in the United States, the inflation is bad. It's running at least like 7 to 9%, and sometimes more in certain categories like food, where the portion sizes are decreasing, the menu prices go up, et cetera, et cetera. But if you go to a developing country and these countries are on a dollar peg, there's just massive inflation in some of these countries like India and South America, and you can see this in the input cost increases in the mining companies. Some of these mining companies have just had massive input cost increases in the last 12 to 18 months.
They really have, and I think, and there are certain exceptions to this rule, but I think as a group, these mining companies have not been as sharp about cutting costs as they could. I think they feel that rising prices will bail them out. But, you know, there are a few that are doing it, and I think it's really going to benefit them in a big way, because they're lowering the cost of production, and that's so important. If your cost keeps going up with the price, how does that improve things? You know, certainly for the shareholders.
Yeah, it hurts profit margins too much, and for every CEO like Keith Neumeier, who has basically kept the production costs for First Majestic Silver flat despite the increasing input costs all across the board, there's, I would say, dozens and dozens of CEOs who haven't been able to do that.
That is correct, and you know, First Majestic, I view as one of the the lead horses, and it's going to continue to be as long as Keith continues on the path he's doing. And another one is Endeavor Silver. You know, Bradford Cook, he presented at the conference, and then I interviewed him for David. You know, for our website, we followed that company for a number of years, since almost the very beginning. And what he does, he goes in and he'll find like this El Cubo deposit they're working on. It's a kind of a worn out mine at high cost and stuff like this, but it's got tremendous potential. And he goes in and he reconfigures the matrix and gets things going again. And then that cost, which is very high now, starts going down, 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 and he works it down, close to zero. And so that then becomes a very productive, profitable asset. So sometimes people go, so-and-so paid too much for that mine. But if you watch what they do, and if they're a good operator like Bradford is, and has a proven track record, then that's not something to be afraid of. But if it's a company that, can't lower the cost and just keeps plugging along and barely making it, then that's one you want to steer clear of,
Exactly, and I remember when Endeavor Silver was a $2 or $3 stock, and the stock never did anything, and the analysts didn't like it. And I remember when First Majestic Silver was stuck at $4 too. And these management teams just continue to, they don't worry about the stock price that much. They focus on growing out the business and fixing the problems that they can actually solve. The stock price is not really a problem that the CEOs can fix, besides actually improving things at the business and getting the mines online and doing what they say.
Right, and I remember year before last, this is before, right at the price point where, the inflection point where First Majestic started its explosive rise from around $12 a share up to about $24. And right at that silver summit, I realized that this stock was getting ready to absolutely explode. And I had no idea how it was going to go, but I knew it was going to be a lot higher than most people thought. And sure enough. And so I really kind of look at Endeavor Silver, and I'm a shareholder in both of these companies, just to let people know. But I think that Endeavor Silver is going to be the next First Majestic in terms of its price appreciation, because the ducks are lining up. The management has shown ever since I bought it at 53 cents, that it's confident. And when problems come up, and it's not that problems come up in the company, it's how does management handle it? Are they transparent with shareholders? Do they get right to work to figure out what's going on and change it? Move on. And when you have a management team like that, like Keith and Bradford do, and a few of these others, then you've got yourself a real gem. And so you don't worry. For example, Arico, it's selling 11 million shares into the market, and it's depressing Endeavor's price a little bit here. But that doesn't mean anything about Endeavor. That's just these shares going into the market because they're moving the shares out that, for when Endeavor bought the resource from them. So if you understand why that's happening, then you don't get shaken out, and you say, oh, gee, if it goes down a little lower, then maybe I'll add to my position, But it's all about kind of keeping track about what's going on with the company in the bigger picture and associating one-off events like this with the fact that, management has an issue, which they don't.
Exactly, David. And as we wrap up the interview here, can you tell our listeners more about your role at the Morgan Report, and then about any other work that you do that our listeners may be interested in?
Sure, Jason. I've been working with David really for about 12, 13 years now, right around since the turn of the century, and I regard him very highly. I consider him a personal friend as well as a colleague and professional associate, and I'm a frequent contributor to the Morgan Report. I have a report that will go in this afternoon about an exploration company up in BC that I visited a few weeks ago. And in addition to writing with David and working with him at the conference, for example, I interviewed several people for the Morgan Report at the conference at Silver Summit. I also have my own writing business, The Right Doctor. It's a trademarked logo, and I do a lot of writing for other individuals, some of it under my own name, and also as a ghostwriter. And so it's a very fun and fulfilling type of work, and I'm always seeking to improve my writing, and it's just a great, enjoyable thing to be doing.
That's great, and I always enjoy listening to your interviews, David, because you have a lot of good insights in there.
Well, I appreciate that, and thank you for the kind words. And, I just love going on these mining tours. I'm going to Mexico here in about less than 2 weeks to look at another silver property, and I learned so much, and being around people that are successful and are forward-thinking and they're not ankle biters, it motivates me to do what I do the best I can. And it's an exciting time to be in this space, and I think it's going to be rewarding to all of us who stay with it and keep trying to improve what we do, regardless of what that task is, because it's going to come back and benefit us going forward.
Thanks, and I really think so, too, about gold and silver. I think we're very, very close to a bottom here. We may go sideways for another couple months, but I think we're at the bottom of the trading range. We'll probably retest the bottom a couple more times, and then we're going to break out again?
That's very possible, and at the very least, I think we could say that we're in an area of good value for the price of the metal itself. You know, nobody really buys the bottom, but if it's good value, that's what's important, and excellent value for some of the very best producers and exploration companies in this space. And if people are willing to do the due diligence, and with the Internet, it's really so much easier now than it was before, go to some of these conferences, do their own thinking, ask themselves, where am I in relationship to my risk-reward profile and my financial capabilities, and then go in. I think it's going to be time very well spent.
Or they can, or to put in a shameless plug here, they can go and buy a subscription to the Morgan Report, which I think has a 30-day free trial if they don't like it, which I think is one of the best values for any paid newsletter. And I've looked at a lot of other paid newsletters, and I think the Morgan Report is one of the top ones for the price.
I totally agree, and of course I have a little self-interest in this, but I can tell you something. I subscribe to a number of other newsletters, and I feel that the Morgan Report is what I'd call first among equals. I have some others that are pretty good, but David has a kind of a calmness about him, the way he structures things and the way he goes about recommending things and giving people information. And I think it engenders confidence in people who listen to him and to read what he's written. And his keynote at the Silver Summit, I told him within moments after he finished, I said, David, it's the best talk you've ever given. And so he continues to grow. He's a lifelong learner, and he's beyond reproach in terms of his ethics and his core grounding. And I'm real proud to be working with and associated with David Morgan.
Excellent. So thank you, David Smith, for coming on, and hopefully we can have you on a podcast sometime soon again.
That sounds great, Jason. Thank you very much for having me today.